Right now, as we speak, Pfizer Inc. is trading at $25.13, down $1.30, which translates to a brutal 4.9% drop on the intraday chart. If you are looking at your screen, you are seeing a sea of red that has completely wiped out the recent consolidation floors. And this is not just a standard market fluctuation. This is a violent repricing event. The market is open. The volume is surging past 68 million shares and the tape is moving fast. The expectation for a company like Pfizer is that it functions as the bedrock of a portfolio, a boring, stable, dividend-paying giant that you hold to sleep well at night. That is what the average retail investor on the Robinhood app or those using Schwab Intelligent Portfolios have been told for years. But the reality playing out on the charts today is entirely different. The reality is that the floor has just fallen out because the future is not looking as robust as the street anticipated, and the smart money knows it. We are seeing a massive disconnect between the safety people expect from this ticker and the volatility it is actually delivering. While you might expect Tesla stock or Nvidia stock to swing 5% in a single session, seeing this kind of heavy drawdown in a legacy pharmaceutical name signals a structural shift in sentiment that we need to analyze immediately. The catalyst driving this downward spiral is the fresh guidance that just hit the wires regarding 2026, and it is catching a lot of people off guard. Investors were bracing for a slow decline in COVID-related revenues, but the numbers Pfizer put out are far worse than the consensus estimates. The company is now projecting 2026 revenues to land between $59.5 billion to $62.5 billion. To put that in perspective, Wall Street was parked at $61.6 billion. That might sound like a small miss to the untrained eye, but in the world of institutional investing, where every basis point is modeled out by Fidelity wealth management teams and hedge funds using Interactive Brokers trading terminals, this is a significant deviation. It tells us that the erosion of their pandemic-era portfolio is accelerating faster than the bullish thesis allowed for. The market hates uncertainty, but it hates negative certainty even more, and Pfizer just confirmed that the hole left by declining vaccine and antiviral sales is deeper than predicted. We are seeing immediate sell-side reaction, with analysts already slashing price targets, and that is fueling the algorithmic selling pressure we are witnessing right now. When we look at the intraday action, the selling began almost immediately at the open. The stock gapped down and has been unable to find any meaningful bid to fill that gap. This is what we call a trend day to the downside, where every minor rally is sold into by larger players looking to exit positions. If you are sitting at home using investing sites or managing your own capital through individual brokerage accounts, you might be tempted to think this is a discount. However, we have to look at the volume. The volume today is significantly higher than the average, which suggests this is not just retail panic, this is institutional rotation. Funds that hold Pfizer for safety are trimming their exposure because the yield, while attractive, is no longer compensating for the capital depreciation risk. It's a classic trap where the stock looks cheap on a PE basis, but the E part of the equation is shrinking. Fidelity mutual funds and other large holders often have strict mandates, and when a company guides down 2 years out, it forces a reevaluation of the stock's place in a conservative portfolio. Let's talk about the retail side of things. If you check the sentiment on SoFi stocks or the chatter on Robinhood crypto forums where traders sometimes discuss equities, there's a lot of confusion. People are asking if the dividend is safe or if this is the bottom. The tension here is palpable. You have new investors who bought in during the highs of 2021 thinking this company would print cash forever, and now they're holding heavy bags. On the flip side, you have value investors circling, wondering if the yield, now pushing higher as the price drops, is worth the headache. This is where self-investing gets tricky. You need to separate the brand name from the business mechanics. Pfizer is a household name, yes, but the stock market does not care about brand recognition. It cares about future cash flow growth. And right now, the company is telling us that growth is going to be harder to come by in 2026. This is why we see such a sharp contrast between Apple stock, which often defies gravity due to its ecosystem, and Pfizer, which is currently fighting against a patent cliff and a shrinking legacy revenue base. We need to address the technical damage on the chart because it is severe. The stock has sliced through the $26 support level like it wasn't even there. That $26 area was a psychological line in the sand for many bulls. Now that we're trading in the low 25s, the next major structural support goes back to the lows we saw months ago. If we close near the lows of the session today, it sets up a very bearish continuation pattern for the rest of the week. Traders using Interactive Brokers platform tools will be watching the relative strength index closely. It is pushing into oversold territory, but don't let that fool you. In a strong downtrend, a stock can stay oversold for a long time. Just because the indicator says oversold does not mean buy. It often just means the momentum is incredibly strong to the downside. We are seeing this across the board in the healthcare sector today, but Pfizer is leading the decline, acting as an anchor on the entire group. This brings us to the broader environment of online investment. The tools available to retail traders today are powerful. Whether you're using Fidelity ETFs to get broad exposure or picking spots with Robinhood fractional shares, the speed of information is instantaneous. 10 years ago, this guidance miss might have taken a day to fully digest. Today, the reaction is instant. Algorithms read the press release, see the revenue miss, and dump the stock before a human trader has even sipped their coffee. This is why understanding the why is so important. You can't beat the bots on speed, but you can beat them on context. The context here is that Pfizer is in a transition period that is proving to be messier than the glossy presentations suggested. They're trying to pivot from being the COVID company to an oncology and weight loss powerhouse, but that bridge is still under construction, and investors are scared of falling into the gap. Now, I want to pause for a second and ask you a question about your own positioning. Comment below how many shares of Pfizer you currently hold, or if you completely exited your position before this drop. It's always interesting to see where the real pain points are in the community. Are you averaging down, or are you cutting losses? Let me know in the comments. Getting back to the analysis, we have to look at the pipeline because that's the only thing that will eventually save this stock. The company has made massive acquisitions, spending billions to buy up smaller biotechs to refill the cupboard. They're betting big on cancer drugs and have been trying to crack the code on the GLP-1 weight loss market to compete with the duopoly of Eli Lilly and Novo Nordisk. However, their oral weight loss candidate faced setbacks, and they're playing catch-up. In the pharmaceutical game, being second or third to market is fine if you have a best-in-class drug, but if you're late and your data is just okay, the market punishes you. Fidelity brokerage analysts often talk about execution risk, and that's exactly what hangs over Pfizer right now. Can they execute on these new drugs before the patents expire on their older cash cows like Eliquis and Ibrance? The market's verdict today is a resounding vote of skepticism. We also have to consider the macroeconomic backdrop. Interest rates are huge factors for companies with debt and for dividend stocks in general. If yields on risk-free treasury bonds are high, the 6% yield on Pfizer looks less attractive because it comes with the risk of the stock price dropping, just like we are seeing today. Why would a Fidelity IRA client hold a stock that drops 5% in a day just to get a 6% dividend over a year, when they could sit in a money market fund? This is the competition for capital that Pfizer faces. It's not just competing with SoFi active investing traders flipping tech stocks, it's competing with the safety of cash. Until the stock price stabilizes and the growth narrative resets, the dividend is the only prop holding it up, and if the stock price falls fast enough, the total return is still negative. Comparing this to other sectors, when you look at Tesla stock, the valuation is based on dreams of autonomy and robots. When you look at Nvidia stock, it's based on the insatiable demand for AI chips. Pfizer's valuation is based on cold, hard math regarding patent expirations and pipeline replacements. There's no dream premium here. It's a show-me-the-money stock, and today they showed us less money than we wanted. This is why online investing in pharma is so distinct from tech. You have to be a scientist, a patent lawyer, and a financial analyst all at once. The Robinhood Investments crowd often learns this the hard way. They see a low PE ratio and think value, but in pharma, a low PE often signals a value trap, a company that looks cheap because its earnings are about to shrink. Despite the gloom, we must look at the contrarian angle. Is there a scenario this is a massive overreaction? Possibly. Markets are emotional.